If you invested $100,000 into an index fund today, which one would actually grow your money more? S&P 500 or NASDAQ 100? That's the million-dollar question we're looking into. For decades, the S&P was the gold standard. It was steady, reliable, and it made millionaires out of patient investors. But now, some people are starting to ask a tough question. Has the S&P 500 become too crowded, too predictable, maybe even a trap? And could NASDAQ be what the S&P 500 used to be? In this video, I am comparing the S&P 500 Index Fund and the NASDAQ 100 to see if the classic approach still holds up in a world driven by technology, AI, and digital growth. I will compare real numbers, real performance, and the story behind both indexes, the long-term trade-offs between safety and speed. And in the end, I will show you which fund turns the same $100,000 into over $17 million, while the other stops at $4. A difference of $13 million. Now, before we dive into the numbers, let's make sure we're on the same page, because an index fund isn't about stock picking. It's a basket. When you buy one, you're buying tiny pieces of the biggest companies in America. You're not trying to guess who wins. You're betting that the American economy, over time, keeps moving forward. And the easiest way to invest in these indexes is through their ETFs. The S&P 500 is represented by SPY, the SPDRS and P500 ETF Trust, and the NASDAQ 100 by QQQ, the Invesco QQQ Trust. Both let you own a slice of hundreds of companies with a single click. So, now that we know what they are, what exactly makes them different? To really understand which of these funds will win, we first need to understand what they actually are, because even though both are index funds, they're built very differently. Let's start with the S&P 500. This index is like a snapshot of the entire U.S. economy. It includes 500 of the largest publicly traded American companies, giants across tech, healthcare, finance, energy, and consumer goods. Think of it as owning a piece of Apple, Microsoft, Johnson & Johnson, JP Morgan, and Coca-Cola all at once. The beauty of the S&P 500 is that it spreads your money across every major sector, so you're never betting on one single industry. It's diversification in its purest form that smooths out the wild ups and downs of the market. When tech slows down, healthcare might pick up. When banks underperform, consumer stocks can hold the line. It's steady, a system that rewards patience more than timing. Now, the NASDAQ 100 plays a very different game. It includes 100 of the largest non-financial companies listed on the NASDAQ exchange. That means it's dominated by tech. Names like Apple, Amazon, Google, Nvidia, and Tesla make up a huge slice of it. You'll also find some big players in consumer innovation and biotech. But the core DNA of the NASDAQ 100 is digital. It's innovation on overdrive, a fund built around companies creating the future, not just maintaining the present. The difference is subtle, but the S&P spreads its bets. The NASDAQ doubles down on disruption. Now here's where many investors get tripped up. They think these two indexes move together because they share some of the same names, like Apple and Microsoft. And while that's true, their sector weights make them behave very differently. In the S&P 500, technology makes up about 36% of the index. In the NASDAQ 100, it's over 55%. That means when tech booms, NASDAQ skyrockets, and when tech struggles, it feels the pain more sharply. So, even though both funds are index trackers, they tell two very different stories. One represents the entire U.S. market, the other represents its most ambitious corner. And that difference, diversification versus concentration, is the key to how they perform over time, because while one is built for balance, the other is built for speed. And that raises the big question. When it comes to long-term results, which strategy actually wins? For decades, the S&P 500 has been the powerhouse of American investing. It's the fund Warren Buffett himself called the best investment for the everyday investor. Historically, it's delivered around 10% average annual returns, slow, steady, and incredibly consistent. That's why so many retirement portfolios around the world are built on it. But in the last 2 decades, something dramatic has happened. The world went digital. The companies driving growth weren't industrial giants or banks. They were software, semiconductors, and online platforms. That shift completely changed the balance of power between the S&P 500 and the NASDAQ 100. Let's start with the most recent data because the numbers tell their own story. If you look at this year alone, year-to-date in 2025, the S&P 500, tracked by SPY, is up about 12.58%. Pretty solid, but QQQ, which tracks the NASDAQ 100, is up 15.98%, noticeably higher. That's not a fluke. Stay with me, because in the end, I will show you which fund turns the same $100,000 into over $17 million, while the other stops at 4, a difference of $13 million. But first, let's zoom out to the past 5 years' performance from early 2021 to today, and QQQ has gained more than 103%, while SPY is up about 89%. That means if you invested $100,000 in each, your SPY investment would now be worth around $189,000. But your QQQ investment would be sitting at roughly $203,000. That's a nice gap. But let's go even wider. Over the past 10 years, from 2016 through 2025, SPY has climbed about 230%, while QQQ exploded by 463%. That's double. And when you pull back to the full picture, the max chart, going all the way to the year 2000, the difference becomes staggering. The S&P 500 is up about 417% since then, while the NASDAQ 100 has soared over 1,071%. That's more than double the long-term total return. But this outperformance isn't out of nowhere. The NASDAQ 100 is loaded with companies that reinvent entire industries. When Apple launches a new iPhone, when Microsoft leads the charge into AI, when NVIDIA chips fuel everything from data centers to self-driving cars, QQQ gets the full advantage of that. The S&P 500, meanwhile, includes all those same stars, but balances them with slower sectors. Banks, oil companies, healthcare, utilities. That's why the S&P grows more predictably, but not as explosively. Now here's where Buffett's philosophy comes into play. For decades, he's told investors to simply buy the S&P 500 and hold it forever, because, as he says, it represents America. And that still makes sense. But the America of 2025 looks very different from the America of 1975. The engines of growth today are digital, automated, and global. In this environment, QQQ has become what SPY used to be, a reflection of the world's most dominant businesses. And it shows in the data. Over every major time frame, 1 year, 5 years, 10 years, and even the past 25, the NASDAQ 100 has outperformed the S&P 500. But, and this is important, it's not a free ride. When the market turns, the NASDAQ 100 feels it more. You can see it clearly on this long-term chart. In the early 2000s, during the dot-com crash, QQQ lost nearly 80% of its value, while the S&P fell only about 40%. That's a massive difference. Then came the next big test, the great financial crisis of 2008. Once again, both indices fell hard. The S&P 500 dropped around 56% from peak to trough. The NASDAQ 100, though less tied to banks, still tumbled almost 60%. Both investors and portfolios were shaken, but the key difference showed up in the comeback. From 2009 onward, tech began its second life. Companies like Apple, Amazon, and Google reinvented how the world operated, and the NASDAQ took off like a rocket. By the time the pandemic hit in 2020, the NASDAQ had become almost synonymous with innovation. And when COVID froze the global economy, both indexes crashed again, roughly 34% in a single month. But here's where the difference played out in real time. The S&P took several months to regain its footing. The NASDAQ 100 bounced back in a matter of weeks and then doubled by the following year. Same was the case between 2021 and 2023. Tech stocks corrected sharply. Inflation spiked, interest rates rose, and investors realized that growth comes with a price. Because that volatility is not for everyone. The NASDAQ 100 can drop 20 or 30% in a bad quarter. The S&P rarely does. That's the risk-reward trade-off in its purest form. You don't get one without the other. That's why this debate isn't about which fund is right or wrong. It's about personality. So the real question isn't which index is better. It's which one matches who you are as an investor. If you prefer consistency and want your portfolio to grow while you live your life, the S&P 500 is your best friend. It's broad, balanced, and designed to smooth out volatility. You're owning a slice of everything: tech, finance, healthcare, energy, retail, and that diversity keeps your future from depending on any single trend. But if you look at disruption and see opportunity, the NASDAQ 100 is your arena. Still, every investor has to ask the hard question, can I handle the ride? Because owning QQQ means living through bigger swings. There will be years where you're up 30% and years where you're down just as much. All right, here's the moment we've been building toward. Let's look at how both funds perform side by side using the same $100,000 investment. The SPDR S&P 500 ETF Trust, or SPY, has a dividend yield of 1.09% and a 10-year dividend growth rate of around 7%. Its historical annual share price appreciation is about 12.59%. The Invesco QQQ Trust, which tracks the NASDAQ 100, has a lower dividend yield of 0.47% and a 10-year dividend growth rate near 2.5%, but with a higher annual share price appreciation of 18.74%. Let's see how those numbers actually play out over time. Starting with $100,000, after the first year, SPY grows to about $113,680, while QQQ edges slightly higher at around $119,210. Fast forward 10 years, and the gap begins to widen. SPY reaches roughly $352,997, while QQQ climbs to about $568,520. That's already a noticeable difference of over $200,000, driven mostly by QQQ's faster share price appreciation of 18.74% per year. By the 20-year mark, the compounding starts to accelerate. SPY is projected to be around 1.2 million and QQQ at over 3.1 million. And by year 30, that same $100,000 investment takes two completely different paths. SPY compounds into roughly 4,042,000, while QQQ grows to an incredible $17.7 million. Dividend income tells a similar story, but in reverse. SPY, with its higher yield, generates about $7,367 per year, roughly $600 a month. QQQ's yield is smaller, producing around $411 annually, about $34 a month. This shows that stocks in QQQ are reinvesting every earnings into growing. Want to know how to make $5,500 per month with only $9 per week? Click the video on the screen.